Yeah, I'm losing my edge.
Celebrating this week, Pete, is something we celebrate once every single month. Non-farm payrolls coming up on Friday. We've got month end midweek this week, and we've got a hell of a lot of stock spreads to talk about. A lot of people traditionally on vacation this week. It's considered a slower week, lighter volumes, and yada, yada, yada. In my head, a lot of excuses for those people out there and a lot of opportunities for the retail traders. What do you think about month end and non-farm on a traditionally low volume, low number of participants week? Could see some big moves. I mean, we're already seeing some big moves this morning.
Absolutely. And I think you make two great points there. So we got a couple of interesting data-driven points. We're not guessing what either of them are, but we do know that statistically, the market moves, and usually the market moves by a large amount. So that's all we really need to know to start to set up. Number one, manage exposure we have, and number two, look for opportunity around both these events. So this is exciting. And you mentioned the other point too, which you really can't underestimate, I think, is the thinner nature of the market right now. July, market's going to thin out a little bit, especially on Friday over a long holiday. So I would imagine that you're going to see maybe a little exaggeration in pricing, but be careful about that, because I've heard that before. Oh, the stuff goes, and it's like everyone's sitting there. It's like not coming back. Well, you know what? All the usual players aren't there to put something back in line. So, be mindful of staying smaller and looking for the extremes and being disciplined around them. So, but the same mechanics hold we've always talked about in terms of opportunity.
And that is a great play for the small exchange products, which is like, because we always talk about, even before the small exchange was a twinkle in Donnie Roberts' eyes, we talk about getting smaller on, there might be greater opportunity when liquidity dries up a little bit and people are on a traditional holiday week. But with that opportunity, you do want to decrease the size a little bit, because if the idea is like, oh, things might move more and you're still getting in at your normal areas, then you're likely the market's going to likely move past you a little bit there. So you don't want to use the full size. You don't want to use the traditionally large futures. So a good play for the smalls. Before getting into some non-farm and stock spreads, Pete, I think this was one of my better ones this week. There's a new Doge in town, Pete. And it's, or you can't teach an old Doge new tricks. Is that funny? Which one of these? Any of these interesting to you? Talking about how the new Doge could be an old dog. We've seen these 2-year yield futures, Pete, ascend more than 100% in the last couple of months here. Big moves in treasuries, giving back a good amount here on Monday morning. You're going to want to check that out. It goes out to subscribers, this article. And what is your viewpoint here on short-term rates, Pete? I did a lot of talking about where rates can go. They can theoretically go negative. It seems like we're getting farther away from that possibility, but they could, after last week or the last couple of weeks, jump higher in yields, Pete. They could go back to zero, but they could, the average for the last decade or so, well above 1%, which would be $10 in the S2Y futures. I was just trying to give some realistic expectations about this future rate trade. I mean, where do you see the range for 2-year yields, say, in the second half of 2021 here?
Boy, that's a great question. I'd like to say in the second half of this week. I feel more comfortable, and still not great guessing.
Just a range.
We both
in general.
Think that there's going to be a little bit of an adjustment, and 50 to 100 basis points. The Fed takes a little bit of the zeal out of the marketplace, but this actually, as stupid as this number is on Friday, it does have some components around pricing and wages. Whether or not they're ascribed to or thrown away is a different question. But I could imagine where a lot of times we won't see the 2-year move on certain things. This is one where the 2-year can move a little bit. I'm hoping it does, because I really like I like the inventory nature of a small 2-year at what did we argue? $52? What was it? 52 or $62 was
It's $61
okay,
is the margin.
$61. There you go.
Yeah.
The ability to warehouse a little bit of this inventory of, we talk about extremes is 1.5%, which seems to be a little bit of the new normal for the 10-year after getting up to 180. They've had a good move, not a normalization move, but they've had a good move. This twos is really still this fascinating extreme, kind of pinned at the low end there by any number of factors. So I think you and I both are. It's one of those times where we really have kind of the same thoughts as to where we think the opportunity is.
And correct me if I'm being ambitious here, but I see the range on a week like this week where rates they've been volatile the last couple of weeks, continuing this Monday morning with that volatile trend here, Pete. And you got a non-farm on Friday, a traditionally big mover for interest rate markets. In the short term, I see this range for 2 years right now at about 25 basis points. That range to be 20 to 30 basis points. And you can correct me if I'm being ambitious there, $2 to $3 in the S2Y futures. In terms of the second half of this year, we have, another, 4 or 5 FOMC meetings. And we have another, I guess 6 non-farm payroll numbers that'll come out. And we have a lot of unknowns here that could factor in. I see the range for the rest of the year here being maybe, 10 or 20 basis points up to 50 or 60. So $1 or $2 in S2Y up to $5 or $6. And that is hundreds of percentage points worth of range, similar to these Doge coins and all these different new cryptocurrency markets that all the speed freaks are trying to flock to, because that's the only place where volatile action is. I mean, this 2-year market has been around 4 decades. I mean, theoretically been around 4 centuries in terms of just an interest rate. And maybe you need to go back to an older product for some big moves here. And I mean, do you see that range as being ridiculous? Maybe 10 to 50 basis points?
And, part of it is when we look, and it's interesting because you talk about that, how many meetings we have left in the balance of the year. And 2-year will reflect off of that, but the 2-year can move. It is 2 years, so it's not capped around that finite nature of how many moves we have left. So I think the bringing forward of a hike, even if it isn't brought forward to December, the just bringing forward the probability could give you that opportunity. So and that's why and this is why we hit. I don't know if this is going to be some thing that happens in October where there's this huge push of growth and inflation, or it's going to be January. I don't know. I just like having a little bit of inventory and not having to be an event picker or time picker. Yeah. And that's what this product gives me specifically.
Yeah, because the idea is the big jump that we saw isn't like, the Fed hiked rates. They didn't do anything, but they brought in the expectation of hiking rates into this 2-year period here. And so they don't necessarily have to even act by the end of 2021 for 2-year Treasury yield futures to move higher. But if they keep bringing in those expectations of more hikes in the next 2 years of duration, this product should theoretically move higher. That's enough about that, because there will be a ton of movement and a ton of eyes on this week's non-farm. And this is how it goes, like when we're content with an interest rate environment and there's not a lot going on, people don't really look at the non-farm payrolls as much. We don't see as much movement. Right now, totally different. All eyes are on interest rates. All eyes are on some of these job numbers and inflation numbers. So it's going to be a pretty big one here on Friday morning, one that I'm sure you'll watch and trade, and one that I think a lot of people should look for and maybe correct, or not correct, but display for everybody the hierarchy of asset classes coming off of this Friday morning move, Pete. What's the most important to least important to completely irrelevant in non-farm payrolls?
Right. Well, first of all, we trade the movement. I don't care about the number. So that puts a little bit of when we rank this, where's the reflexive portion going to be? It's going to be in interest rates. There'll be some spillover into the dollar. So I'm going to be watching rates, the dollars, equities, then the second tier movers come in, gold and silver. Crude drops down a little bit. And then at the bottom of that are my grains. So that's kind of where I would look. And, I give the caveat because this is it's very much a backward looking number on stuff that tends to still have reflexive movement. But this is one why I particularly like to look for those levels, set those 1.5, 2 standard deviation levels, and look for some opportunities to trade against it.
Very cool stuff. And yeah, this is another interesting one. Crude oil, definitely not a first or second tier mover off of something like non-farm, but something that has started to move already here on Monday morning. A lot of people groaning about the fact that oil moved through those multi-year highs of $70 a barrel, and they did a little dance up to $74 a barrel,
Right.
Pete, coming off a little bit this morning,
Wow.
but a very intriguing range here on the week. The early part of the week, the range is really 72 to 74 and a half. As we get to the end of the week, if you see prices, and I know you've been good about this, you're ready to trade both sides of this oil market. If it gets down to 72 or $71 a barrel, you're looking at potential long plays in crude oil. If it gets back up to 74 and a half or 75, maybe adding some shorts. This is a pretty nice projected range for small crude oil futures, right?
I agree. And I think I am, crude does have a proclivity to burn you sometimes when you try to trade the range. It's been very unlike the spree we've been trading in terms of a range and stuff like that. So you do have to be a little bit mindful. But I'm going to take the range until they give it to me. We spent a lot of time trying to get through $70. We'd spent a day above 70, 30 and not. So I'm going to take the 71 and a half, the 75 and see how that works for me. I wish I had more tools. Vol's so low. It's hard finding volatility strategies that pay you anything. And you're getting so close. It doesn't feel great. But small products, SMO works great. Small, couple of those back and forth, looking for $35 to $50 on the scalps. That could pay you nicely in a range.
Yeah, we love to add options, and like you alluded to, trading the small precious metals futures in that range. We would constantly, sell silver and gold options against it. Volatility is just dead in this crude oil market right now. So unfortunately, but maybe fortunately, we'll see how the range goes this week. This has become a little bit of an outright trade with the small crude oil futures. And finally, Pete, and maybe you can rank these, because I put these three spreads together and you can rank them in terms of most to least interesting, and you're not going to hurt my feelings. So be as transparent and honest as possible. I put together 3 short stock pairs trades here, given the fact that stocks are at their highs, although giving up some ground here at their highs. So maybe I was ahead of the curve. Long pot stocks versus short stock market, long 30-year yields versus short stock market, long gold and silver in the precious metal space versus short stock market. Rank them 1, 2, 3, go.
I'm going to have to take number 3 as my number 1.
Oh.
Like the spree, like the SM75.
Okay.
So
that's a long spree contract and a short SM75 contract. That's
I
number
know
1.
you love your rainbow trades. You love throwing the smattering of long interest rates against the short equity trades.
I do love it.
It just, it hasn't worked in the way I would have wanted it to. And you look at rates again today, we're 147 in the 10-year. The ZB, the long end, is up at 160.05. We were down to 158.19 yesterday. So it just doesn't, I just can't count on those paying for my short equity exposures. So I'm going to go and choose my second choice will be the S420. But by a good stretch, I do like the spree SM75 trade.
Okay, interesting there. Yeah,
well done, my friend. 3 good trades.
Yeah, the yields haven't bounced back as much as they have in the past here, but I still like that trade. So Pete likes the long metals versus short stocks. That's number 1. Long pot stocks versus short stock market. That's number 2. And that's a 3-to-1 ratio, the S420 to SM75.
Right.
And then the S30Y versus SM75, also on a 2 or 3 to 1 ratio. That's number 3 for him. All intriguing, though, Pete. Thanks so much for joining me on this edition of Small Stakes.
Thank you for having me, sir.
Back. Yeah, of course, man. We'll be right back with Splash into Futures coming up next. We're going to have a blast here. Markets are starting to move on Monday afternoon. We'll get some trades together, Pete, and then get the hell out of here. Hang out, everybody. We'll see you in a little bit. Thanks.